Namaste, good morning. Welcome to this session where the prime focus is completion of non-resident taxation. Okay, and moving forward. Okay, that is completion of non-resident taxation and moving forward. We have started traveling into the chapter by understanding the residential status computation. By understanding the residential status computation of individuals along with an amendment and companies along with POEM guidelines, place of effective management, when a company will have its, when can you say that a company's place of effective management is located in India. That's where we led our discussions to. And then we also had a small extra thing of the transition provisions, which are set in 115JH in the first year of operation, where due to POEM guidelines, if a company becomes a resident entity, how to go for it or how to account for it or treat the various items. Various items means depreciation and brought forward losses. Today, we start with the scope of total income arena. Today, our starting point is scope of total income. Again, I want to tell you that our primary focus of study is non-resident taxation. So, only from the eyes of the non-resident, I am looking at the provision. Okay, I am not looking at the provision, though we might do ROR, RNOR just to brief. We have that as a study for the 8-9 classes that are coming up. But from the non-resident's perspective, what is the scope of income? If I am a non-resident, on what incomes should I pay tax in India? If I am a non-resident, in what are all the incomes which becomes taxable in India or the incomes for which I need to pay tax? Okay, it starts with income that is received in India. Wherever you earn, the first test is receipt test. If you receive the income in India, such income becomes taxable in India. The bottom line of the scope of total income. The bottom line of the scope of total income is between the taxing nation and the taxed person, there should be nexus. Nexus means link. Between the taxing nation and the taxed person, there should be a link. Otherwise, between the taxing nation and the income, there should be a link. Okay? So, in the case of ROR provisions, it goes to the first point. Taxing nation and the taxed person has a link. So, global income becomes taxable. Whereas in the case of NR, it goes to the second principle. I know the relationship is not with the person. I know that the association or relationship is not with the person but with the income. between the taxing nation India and the income, if there is a link, then our government will tax. Our tax law will ask the non-resident to pay tax on such money. Traveling in the direction of establishing the link, the first criteria is if you receive the income in India, receiving is different from repatriation. Receiving is a direct act, whereas repatriation is an application of money received. I work in a company and earn salary. That is a direct receipt by me. Taking that salary and spending is known as application of income. Here, in our non-resident taxation, where are you receiving it? If you have received it outside India and then bringing it into India, I have to encourage it. I means the Indian government has to encourage it so that they should not tax because we are earning foreign exchange. Repatriation is never taxable. Even if the wordings of the law is past untaxed income brought into India, still it is not taxable in the current year. For that there are provision, unexplained cash credits, etc. We will see when we are doing the direct taxation part. But even if they use the word past untaxed income brought into India, bringing into India is never a taxable event. Only if the direct receipt is in India, it is taxable. Deemed to be received in India. The word deemed means supposed to be. Any government accruals. Any government accruals, you can see excess contribution by PF by employer, interest credited, conversion of URPF to RPF, national contribution to national pension fund. These are government contribution. These are deemed to be received in India. Even if you are outside India, but it is credited to your PF account here, or it is deposited in your pension account here, you are deemed to have been received that income in India. Not a great provision, don't worry. Then comes what is popularly known as source rule. These two we call it as receipt rule. The next two is known as the source rule. The origin of income is India. The origin of income is India. The source of the income is from India, where income is accruing or arising from India. Sir, I worked for Government of India, got retirement, I went and settled along with my son in US. Every month, the Indian government pays pension. Now I am a non-resident. Now I am a non-resident because I got my green card and settled there. But the pension I receive is accruing from India for the services rendered in India. I am getting the pension. I deposited in the bonds of an Indian company. I invested in the shares of an Indian company. Now I am outside India. The company pays me interest or dividend taxable in my hands as the origin is India. So we always, at our level, we can understand what I am saying. If it is allowed as an expenses in India, that means for the person receiving, it will be treated as Indian income. Exceptions are there, but on a broader scale, understand this. If you are preparing the profit and loss account and allowing it as an expenses in India, for the recipient, it becomes an Indian income. So, accruing or arising from India. Supposed to accrue or arise from India. I will tell you. One place I will tell you how the law interprets this. Okay? It is deemed to, supposed to have been accruing or arising from India. Let us go headwise and understand so that we are very clear. Whenever it is talking about income, we have always been fantasized or we always like to go headwise. Let's do that. Salary. When is the salary accruing or arising in India? When the services are, sorry for the spelling, rendered in India. When the services are rendered in India. Salary accrues or arises when the services are rendered in India. The place of completion of services is India. One exception. Though you are outside India, though the person is outside India, it will be taxable. Salary payable by government here means government of India, to Indian citizen working in embassy or high commissioner's office outside India. Once more, salary paid or payable by the government of India to whom? To whom? Your answer should not say to persons working in ambassador or high commissioner's office. No, I am very clear, to Indian citizens. Because if in the American Embassy of India, okay, sorry, if there is an Indian embassy in America, I employ some Americans to work there. For them, it is not taxable. For them, it is not taxable. For them, it arises because they are rendering their service in that country. That country will only tax. Where am I coming? Salary paid or payable by the government of India to an Indian citizen working in an embassy is taxable in India. Those services are rendered outside India, it is taxable in India. However, only salary is taxable. Allowances and perquisites I will not tax. However, allowances and perquisites I will not tax. Okay, for a minute hold. Can I tell you the reverse of it? Can I tell you what about an American working in India in the US embassy? What about an American working in India in US embassy? he is receiving salary in India, but his government will also have same rules. So will both government tax? This is where I am just taking you outside this and going to the next arena. Exemptions applicable to non-residents. Look at section 10 subsection 6. Look at section 10 subsection 6. Remuneration received by officials of embassies of foreign state. Remuneration received by an individual who is not a citizen of India. Do you understand how that's their provision? Suppose if an Indian citizen works in the US embassy in India, suppose if a ROR works in a US embassy in India, I will tax him. I am only giving this exemption because there also it is the same. If he is not a resident, I will not tax that person. If he is not a citizen, I will not tax. Only Indian citizens paid by government of India, I will tax. Indian citizens paid by government of India, I will tax. If he is not an Indian citizen, but he is paid by government of India, I will not tax. That government will only tax. So the same remuneration received by an individual who is a foreigner for services of official nature in the embassy, high commissioner, consulate is exempt, provided remuneration received by our corresponding officials there is also exempt. I am ready to give exemption for your embassy members, provided your government is ready to give exemption for my embassy members. And the above mentioned official should not be engaged in any business or profession in India. He should be an employee. Okay? Okay? So, yes, I am taxing them. There they will be exempt. Here I am giving them exemption because there they will be taxed. That is the understanding across the world. Okay? So, coming back to the terminology, if services are rendered in India, paid by government to an Indian citizen working there, it is not taxable. However, allowances and purposes which are purely foreign income is not at all, is exempt under 10(7). House property income. If the house property is located in India, it is taxable. If the house property is located in London, is it taxable for a non-resident? Normally, no. But if he receives the rent in India, then I will tax it. Then I will tax it. Okay, house property. Coming to the core, the fulcrum of our discussion. Business or profession. Coming to the main aspect of our discussion, when will business or profession income earned by a non-resident will be taxable in India? There is one coinage. If there is business connection, then it is taxable in India. What is it? If there is business connection, then it is taxable in India. That leads us to the question, what is meant by business connection? That leads us to the question of what is meant by business connection. What is meant by business connection? Business connection includes any business activity performed by a non-resident. Any business activity performed by a non-resident through his agent. And what that agent does habitually concludes contract on behalf of the non-resident. What does that agent do? Habitually. Friends, the word habit in English terminology is recurring in nature. I have the habit of eating apples means not that only once I will taste apple. I have the habit of visiting places. I have the habit of watching FDFS of all Talavar movies. It doesn't happen once. It is a recurring activity. It is a recurring act habitually. So, repeatedly concludes contract on behalf of non-resident. He takes the decision, concludes contract. Now, I'm just not introducing so and so, so and so, so and so. I take the ownership and conclude the contract. Habitually plays the role on conclusion of contract by the non-resident, and such contracts are in the name of non-resident for the transfer of ownership, right, or use of services. See, the agent holds the stocks, stores, and delivers on behalf of non-resident. The agent here, the non-resident sends goods, he receives it, stores it, and delivers on behalf of him. Habitually secures orders in India. Habitually secures orders in India. Repeatedly secures orders in India. Once more, habitually enters into contract, habitually receives stock, stores and delivers on the instructions of non-resident, habitually secures orders in India. If these are fulfilled, then there is business connection. Then there is business connection. Okay. Now, the law little goes up and elaborates. Habitually concludes contract, receives, stores and delivers, secures order to whom? To a non-resident. Let us take that a non-resident, that a non-resident is there for whom I am securing orders. Is the business connection established? Yes. That non-resident to whom I am securing orders is controlled by one other person, one other non-resident. Shall I repeat? That non-resident to whom I secures orders is controlled by another non-resident. Our law says your business connection is established with the other person also. Your business connection is established whether you habitually do or not with that other person also. The reverse can also happen. The non-resident for whom I secures order is controlled by another person. Whether he controls or the other person controls, business connection is established. Third case, both of them are controlled by a third party. Business connection is established. This is what in law we popularly call it as directly or indirectly. In law, everywhere they will say, whether directly or indirectly. Sometimes the business connection can also be in an indirect manner. Mr. A secures order to Mr. X, a non-resident. Secures order habitually. Business connection established. Mr. A secures order to Mr. Y, who is controlled by Mr. X or controls Mr. X. Once more, A secures orders to Mr. Y. Who is Y? He is one who is controlling X or X is controlling him. Business connection established both with X and Y. Both with X and Y. Mr. A secures orders for Mr. X or Mr. Y. Both of them is controlled by Mr. Z. BC is a business connection is established with all three parties. Business connection is established with all three parties. Are you understanding? Direct, indirect, on a global manner, the business connection can be there. So, what is business connection? We started understanding. Habitually means repeatedly, concludes contracts, secures orders, receives, stores and delivers goods. In all these things. In case of business where all operations are not carried out in India, the income that is reasonably attributable to the operation carried out in India is considered as Indian income. I am asking you now to recollect whatever I was telling you yesterday about APA. APA can be entered into. Advanced pricing agreement can be entered into for determining method of ALP, for determining the ALP, for definitions, and I told you also, it can be entered into to specify what proportion of income is taxable in India. It can also be entered into to understand that it is a streak of transactions which happen at various parts of the world. Some part of the transaction is having a business connection in India. For that, what is the portion of income that needs to be apportioned can also be now part of APA, can also be now part of APA. In case of business, where all operations are not carried out in India, income that can be reasonably attributable to the operations carried out in India is considered as business income, business connection. Business connection also includes significant economic presence. PEP's OECD guideline this is. Significant economic presence because of web space, where there is no land area or where you cannot certainly say where from the income is accrued. Our income tax law in 2019 itself gave what is meant by significant economic presence, but postponed its application from 1920 to 2021. Now in 2021, in your previous year, for the previous year for which you are writing the exam also, it is not there. It includes significant economic presence is there, but they have not defined it. I mean, that is not applicable. That is why I have striked it off. I believe you can read what it is. Transaction in respect of goods, services, or property carried on by a non-resident, including the provision of download of data or software in India. If you are able to download, today we are all doing it. Take this, some of you would have downloaded this WebEx app. Okay, you're paying, okay, from our end, let us take Bharatwaj Institute. We paid for WebEx platform download. Is they having a significant economic presence? Depends on systematic and continuous soliciting of business activity. Systematic and continuous soliciting of business activity. Amazon Prime, they chase you with offers. Engaging in interaction with active users in India. WhatsApp through digital means. However, the turnover or users should exceed the prescribed limit. This is not explained yet. What is the turnover or what is the users? Not yet explained, because it is also difficult to explain, because countries across the world have different population level. Two of our Asian region is having the highest population, very difficult to, I'm not going deviating, but this is not there. This is significant economic presence. They are defined and kept, but not there for your examination. Okay, so business connection includes significant economic presence. Quick, habitually concludes contract, secures order, stores and delivers. Where a part of the transaction is in India, then that income which is attributable for activities carried on, and it also includes significant economic presence. Finance Act 2020 brought this amendment, and unfortunately this is also postponed. The application is postponed to 21-22. This is all the more difficult from significant economic presence. This application is also, they are not, it is not applicable for your year, but you, since it is a Finance Act 2020, I have not striken it off. What is income attributable to operations carried out in India? Income from advertising, targeting customers residing in India, or accessing advertisement through internet protocol address located in India. For you, IP is a better term. A stands for address. Okay, internet protocol address located in India. You are doing an advertisement targeting Indian customers, or accessing advertisement through an IP located in India. Income from sale of data collected from persons residing in India, which is a bigger income, or using the IP located in India. Income from sale of goods and services using data collected from persons residing in India and using, okay, both goods and services. Okay, not yet applicable. Just remember the explanation. Very difficult to track this. What is not considered as business connection? Mere purchase and export of goods is not business connection. In India, you are purchasing, immediately exporting, not business connection. Shooting of cinematographic films, collection of news, BBC or any other channels, agents who are not representing non-resident but have independent status. All I told you is directly representing. Activities confined to display of raw diamonds or rough diamonds. Okay. In a special economic zone, this provision alone is only for companies. This provision alone is only for companies. A quick read of business connection, please. Okay. If at all there is a question on section 9 business connection, right? What is business connection? There itself our paper will be well. That is, you can able to interpret it habitually. Quick, small wordings only, not exact recollection. Habitually concludes contract, habitually secures orders, habitually receives stores goods, includes significant economic presence, and also business income that is attributable to Indian activity. Okay, so that our answer stands tall. So I have completed 3 heads. Salaries, you have a clarity. House property, dot on business or profession based on business connection. I am going into capital gains. If the asset is located in India, this is for immovable property. If the asset is located in India, then wherever you earn the income, wherever you sell it, it is taxable. If the asset is registered in India, shares of Indian company, debentures of Indian company, patents of India registered under Indian patent law, like that. Now comes, uh, it's already too old. I don't know why we are dwelling upon it. Again, sorry to deviate. Okay. Now comes the famous Vodafone case. And the law amended because of the Vodafone case. So I'm not talking about the case and taking your time off. Okay, recently also you saw the finance minister saying that I will only make prospective, not retrospective. This was a promise given for 7 years by them. Okay, now coming back. I am a company in, let us take Dubai. Okay, I am a company in Dubai. Company registered in Dubai. The balance sheet of the company, liability, share capital, okay, some, let us take 40 lakhs, uh, secured and unsecured loans, let us take 30 lakhs. Assets, fixed assets, let us take 10 lakhs. Investment in an Indian company, 60 lakhs. Now, this Dubai company sells their shares, or this Dubai company sells their company itself, sells their shares totally to another person. Normally, if you sell the shares of Indian company, it is taxable in India. Look at it from non-resident perspective. For ROR, global income is taxable. That's why at the beginning of the class itself, I said, please look at it from the non-resident's eyes. I'm a non-resident. You should all think you are a non-resident. If you sell the shares of Indian company, taxable in India. You are a non-resident in US. You are selling the shares of Apple Incorporation. Can the Indian government tax you? No, they cannot tax you. Here is a circumstance which is very unique. This Dubai company is selling their company or selling the shares of the company. Now, their share capital is 40 lakhs. Original investment of the company is 40 lakhs. Selling now for 200 lakhs, example wise. How come the company's value went up? How come the company's value went up so much? Because the investment they have made in Indian companies' value went up. I have invested in an Indian company, that is my asset. And my asset value went up. Had they sold this, no, it is taxable in India. You all accept with me? Had they sold this, it is taxable in India. In order to avoid what they did, they formed it as a company. That company invested and they are selling the shares of that company. Hutch, Vodafone, Hutch Netherlands, Hutch Mauritius, Coland Islands. But the substance of the value is not because of your other things. The value is derived because of your investment in India. The value is derived due to the investment in India. So, okay, an asset or capital asset being shares or interest in a company or entity registered outside India. Okay, shares outside India, it has nothing to do with India. Shall be deemed, I told you, deemed, I will come to the best example. Shall be deemed to have been situated in India. I will assume that the shares in India, when, if the shares or interest derives directly or indirectly, value from assets located in India. If the shares or interest derives always directly or indirectly, its value, not normal value, substantially from assets located in India. Value substantially from assets located in India. Then I want to tax that transaction in India. Then I want to close the gate and tax the transaction in India. Sir, I sold the shares of Dubai company only, sir. Okay, sir. How come the Dubai company's share value went up? Because I invested in an Indian company or Indian asset, sir. That asset went up. So indirectly what you have done is, you have sold the shares of Indian company only. Indirectly, because directly or indirectly. And the law also explains what is that. Explanation 6 specifies that shares or interest in a company or entity registered outside India shall be deemed to derive its value substantially from the assets located in India if on the specified date the value of Indian asset is more than 10 crores and or illa and together both the conditions should and represent at least 50% of the total assets of the company. My total assets is 10 plus 60, 70 lakhs or crores if you change it, just for the purpose. This exceeds 10 crores and also more than 50%. So this sale is because of substantially from assets. Okay? Substantially. What is substantial? Substantial value from assets located in India. What are all the two criterias? Value of asset should exceed rupees 10 crores. Such value should be 50% or more of the total asset of the company. Such value should be 50% or more of the total asset of the company. Something which I have not mentioned in the material, I am writing now. That's why, okay, a small notes if needed. First, listen. Okay. Both these things on specified date. Now, the law has also answered. That's what I missed. What is specified date? What is specified date? Actually, the law has answered this question. The preceding financial year end. Let me take for example 18th August 2021 selling. Value of assets on 31st March 2021. Before the sale, when did the year end date come? Before the sale, when did the year end, the preceding financial year end? Okay, on that date, you see whether it is 10 crores plus 50. Only asset should be considered. In other words, liabilities should not be reduced. Sir, how can I understand this in law, sir? Usage of words only, my dear friends. If the net worth is more than 10 crores, then we should reduce liability. If the total asset value is more than 10 crores, you should not reduce liabilities. Okay? Here the law has used total asset value exceed 10 crores and 50% of the total assets. Okay? So, only asset value, it should not take liability. Having said this, the law makes us one more thing. Okay, coming back to the example, 18th August, if I am selling, I should take the preceding 31st March, year end. Suppose the value on the date of sale, value means fair market value. Suppose the value on the date of sale exceeds by 15% from the value of year end, then specified date will be date of sale. Specified date will be date of sale. Let us take asset value on 31st March 21 is 25 crores. Sale happens on 18th August. Value on 18th August is, let us take 26 crores. Only 25 crores will be taken. Value on 18th August is 30 crores. Is 30 crores. Value of the asset on 18th August, date of sale is 13 crores. 115% of 25 crores. How much is that? Okay, 25 crores into 115%, okay, is 28.75 crores. The value exceeds, okay, by 15% of balance sheet value. Hence, 30 crores should be considered. This I missed the theory in the material. Okay, once more, I'll give you time, don't worry. Once more, where value is substantially from assets located in India. What do you mean? Everywhere the word substantial is used. Chennai Properties and Investment Case Law. Whether rental income from house property should be considered as PGBP or IHP. Where the main business, the main object of the company, is letting out of property, and the substantial portion of income is also from let out. Main object class anybody can write. And the substantial portion is also from, a part of income is also from let out. Then I accept that the income is, rental income is taxable under PGBP. Where a company gives loan or advance to a shareholder, it will be taken as deemed dividend in the hands of the shareholder. However, if the company's substantial business is lending, and it has lent in the normal course, I can keep on giving you example. Two things which I should not do. One, I don't want to display that I know all these things. Actually, I also don't know. Just recollect, so I say, okay. Two, I don't want to waste your time keeping on like this. I'm just telling you, substantially means 51%. You be sure everywhere in law, except substantial interest holder, that is for an individual. Otherwise, wherever they are going to use substantial, is talking about 50 plus. So here also, when I say substantial portion, that means I have two conditions. It is not either or, it is both. It should exceed, the asset value should exceed 10 crores, and the asset value should be at least 50% of the 50%, at least 50% means 50% or more of the total assets of the company should be Indian investment in Indian shares, securities, etc. Okay, on which date? On the specified date. What value? The value is on the balance sheet. However, on the date of sale, if the value from the balance sheet value exceeds 15%, so 115% of the balance sheet value or more, then be sure That value should be, that date should be taken as the specified. Quick marking in your book. Your book or not. Okay, right? Dubai-based company which has substantially invested in Indian assets. Now you know what it is. Abhiprita, a shareholder, sell a shareholder of the Dubai company, sells shares. Is it taxable in India? Yes, because the company derives its value, the shares derives its value because of Indian assets. She is just holding 3% of the shares of the Dubai company. Sir, I am a small shareholder, sir. I don't know what that company is doing, where it is. I am a small shareholder of that company. Will not be taxable in India, provided. Suppose if this is the case, I'll give you an example. Abhiprita just holds 3%, up to 5% not taxable. That's the exemption I'm coming to. If you are a small shareholder, it is not taxable. I accept that you don't know it. But what happens is, balance 97% is held by her parents. Then it is taxable. Then it is taxable. Will not be taxable provided Abhi is not directly or indirectly controlling slash managing the company. Okay. So the law says, however, this is not applicable to a shareholder who holds 5% or less in the company. This is also not applicable for non-residents investing in alternative investment funds by SEBI. Leaving that spot, not 5% or less. But she should not be, that person should not be in controlling interest of the company. if they have control interest, because a relationship, you will see it in BEPS, you will see it in chapter 10, sorry, impermissible avoidance agreements, guard provisions. So less than 5%, I find 25 shareholders all holding 4%. But all of them are interlinked. 25 shareholders holding 4%. All at that time, I will not give you this pen. I will again repeat when I am reading GAR, I will tell you this. Look, we studied there. Okay. My intention of starting with international taxation was something very different, which some of our friends here might understand. But fortunately, now I have a good amount of time for you to recollect international taxation when I am doing an administrative provision or a direct taxation provision. Look, in international taxation, we solve this like this. Okay, right, coming back. So this is so can I conclude capital gains? When will capital gains be deemed to accrue or arise from India? If the asset is located in India, if the asset is registered in India, or if it is a foreign asset. What type of asset? Shares or interest in a foreign company. How do you say it is in India? Because that shares or interest derives substantial value due to an Indian asset. What is substantial value? Two conditions. Are there exceptions? Yes. Salaries, house property, business or profession, capital gains. My last part of the discussion is other services. 2019 amendment. Now it is not for your ear. This is an already amended provision. Gift provided by a non-resident, a resident to a non-resident even outside India is taxable if the aggregate value exceeds 50,000. So for gift is taxable. Interest. Is it taxable in India? Yes, if it is paid by a resident. If it is paid by a resident, it is taxable. If it is paid by Government of India, it is taxable. If it is paid by another non-resident where the loan is utilized for business or profession in India. Two non-residents, X incorporation gave loan to Y incorporation, Y with the intention that Y incorporation will invest it in India. The interest earned by X incorporation from Y incorporation will be taxable because the money is used for business or profession in India. Here there is a small exception. Interest paid by a resident. However, if the resident receives loan outside India, uses it outside, then it is not taxed. Okay. Here there is a small exception. If the resident Indian, normally interest received from a resident Indian is taxable. But if the resident Indian gets the loan, there was a question once also. If the resident Indian gets the loan outside India, uses it outside India, then it is not taxable. Royalty or fees for technical services, same. Paid by a resident, paid by Government of India, paid by a non-resident where it is used in India. Okay. I have written, I did not use the word not tax. No, this is for business or profession taxable. Where okay, look at this. Where a resident avails loan or benefit from a non-resident outside India and uses it for business or profession, then also it is taxable for non-resident. If it is not for business or profession, because that question, if I remember, we will do that question. If I remember, they would have said it's a personal loan. Okay, then it is not taxable. If it is a business or profession loan, it is taxable. Dividend, we all know it is an amendment also. I haven't put it in blue. It is an amendment also. If dividend is paid by Indian company, it is taxable irrespective of the place of receipt because 115O is gone. CBDT has clarified. So this company, which we said, the Dubai company is declaring dividend. Is that taxable? Because it has received its substantial value from India? No. Only capital gains is clear. CBDT has clarified that dividend is paid by a foreign company which derives its value due to assets located in India. Such dividend will not be taxed. Only the capital gains is taxable, not the dividend. So, 5 heads deemed to accrue or arise. 2 minutes for you to go through. Okay. So, income, accruing or arising, scope of total income. So, okay, we are with this completing section 9. We started from section 6, if you remember. 6 speaks about residential status, various parts of 6. 7, 8, 9 are speaking about the incomes which are taxable for India, in India for non-resident residents, everybody. This is one, in between we traveled to 115 JH, but this is the one part. Moving on to section 10. What we need to understand in section 10 for a non-resident. What are all the incomes that are, I told you, I'll again do it. Interest income. NRE account interest is not taxable. Any interest on amount standing to the credit of NRE is exempt, provided it is permissible. Otherwise, I don't know how they'll open, but still. It is further mentioned that the joint holders of an NRE will not be treated as AOP. Their income will be, okay, husband and wife. They have a joint account, NRE account. Both of them are not resident. It is still exempt independently. Interest income of RDB, rupee denominated bonds, this will be now popular, issued by an Indian company or business trust. The only condition is money should be borrowed from outside India. 10.6 remuneration, first part I told you. Remuneration received from foreign national for services rendered in India. Okay. Example, I am importing a machine from Germany and I need that to be installed. So, the condition is we will send our engineers who will install it and just check whether the operations are going well for 15-20 days. The installation might take 20-25 days. They might stay further for 20-25 days. So they are in India in that time. But they are the employees of a foreign enterprise. Is it taxable in India? Normally, yes, but this is the section which gives the exemption. During his stay in India, the remuneration of a foreign national from a foreign company, if the Indian company is going to pay, it is taxable. The remuneration I am a foreign national, non-resident, and the company which is paying me is also Germany, provided foreign enterprise is not engaged in business in India, employee stay for less than 90 days, okay, and remuneration is also not liable for income tax TDS in India. Remuneration in connection with employment in a foreign ship. We all know ship enters Cochin port, Cochin to Vizag, Vizag to Chennai, Chennai to Bombay. All of the ship crew members will be inside the ship. They will be foreigners. Territorial waters of India. But is that taxable? Recipient should be a non-India, okay? Ship should be a foreign ship. Aggregate stay period should not exceed 90 days. It is not taxable. Remuneration received by foreign government employees during their stay in India for special training. Okay, so it is for exchange programs, etc., which is given. Don't worry about royalties. These are about aircraft royalty, tax paid by Indian company engaged in the business of operation of aircraft, which has acquired. Okay, so so whatever aircraft scams that are going on, etc. Okay, National Technical Research Unit royalties, etc. Not very important. Interest on deposit made by foreign banks. Obviously, we should give them exemption, no? A bank keeps deposit in the scheduled bank. Okay, so it is not taxable in India. Okay. The next is crude oil. We all know that it is I'm not covering 10.4D here. I have IFSC as a special area to cover. In your material itself, you would have seen. I mean, the beginning notes itself, I have said IFSC I will separately cover, because all the provision in one umbrella I want to give it to you, so that you need not search everywhere. So I will why 10.4D is not there. People say it's important. It is important. It is coming down. Okay, this is for crude oil reserve, foreign companies. Income received in India in Indian currency on account of sale of crude oil or any other goods or rendering of service as may be notified by central government. Okay, so a foreigner selling, a non-resident selling crude oil, okay, or any other goods of a related nature will be exempt. Even storage will not be taxable. Income accruing or arising on account of storage of crude oil. Okay. Because it is continuously texting, I thought some of you telling me that some problem. Income accruing or arising on account of storage of crude oil facility in India is also exempt, but even after withdrawal of exemption, the stock in hand, income from leftover stock of crude oil from facility in India after the expiry of arrangement also, even in the year in which there is a amendment also, I did not see a question in this. Even in the year this was amended in 2018 and 19, I did not see a question in it, but I just want to put it, these things, put it somewhere inside your mind. If at all there is a question, immediately crude oil, okay, it is having some exemptions, that's all. Capital gains exemption, exemptions and special provisions from capital gains for non-residents. I am only talking about non-resident, only talking about non-residents. Transfer of bond or GDR by a non-resident to another non-resident outside India. It's not taxable in India. Okay, it's not at all regarded as transfer. Section 47 is transactions not considered as transfer. Transfer of rupee denominated by a bond by a non-resident to another non-resident, IFSC will take it up. This is something. Capital gain, all of us should remember, for a non-resident. For a non-resident, capital gain can be computed in foreign currency. capital gains can be computed in foreign currency. What is that? I will convert the INR into foreign currency. We will see how to convert and then compute capital gains, but not available for LTCG on sale of shares and securities on which STT is paid. Not available for STT payment, and concessional rates are 10%, and they will not have the indexation benefit. They will not have the indexation benefit. Read through once. Okay, so exemptions, basically remember NRE account exemptions, royalty and all very rare, crude oil somewhere, and 1040 we will see later. Okay, and this is an amendment. In your amendment lectures, probably you would have seen this. I will quickly have a recollection of it. Okay, I request you to look into the amendment lecture for a detailed discussion. So what happened is, there are many foreign funds. If, for example, pension fund in India, provident fund in India, the provident fund department has that fund. The pension fund department has that fund. I am making them invest in infrastructure projects so that they earn income. They also pay the persons who are contributing, etc. Like this, every country has. So when the Indian Prime Minister visited Abu Dhabi, the Abu Dhabi king offered, the prince offered investment in India through their sovereign bonds and other things. We took that as an opportunity to bring in these provisions. Though originally it was for Abu Dhabi Investment Authority, which is a nodal agency of the government of Abu Dhabi, then we also extended it for sovereign wealth fund, and so we used this opportunity. Oh, not only Abu Dhabi, we can invest, we can invite some foreign pension fund, sovereign wealth fund, specified pension funds to come and invest in infrastructure in India, and that will bring us foreign exchange. The only thing I need to do is the returns I have to give them exemption. Let me give that exemption. So came this provision called the section 1023 FE, which is available for subsidiaries of Abu Dhabi Investment Authority, sovereign wealth fund and sovereign pension fund. Okay, sovereign wealth fund and sovereign pension fund. First, let me complete that and come. What is sovereign wealth fund? Owned and controlled by the government of a foreign country. I'm not giving it for private sector people. The Abu Dhabi king triggered this to us. So, every foreign government has funds. Whether they will come and invest outside India, that is different. Let me open the gate and keep. Owned and controlled by government of foreign country. Set up and regulated by the law of that country. Earnings of the fund should accrue to government and not to a private person. Assets should vest with the government upon dissolution. They should have that document. Does not take any commercial activity specified by the central government. And similarly, pension fund should be created under the law of a foreign country, including the laws made by any of its political constituents during a province, state or local. So, to help countries which are not yet got their full independence. Should not be liable to tax in the said foreign country. That pension fund satisfies other conditions. So, if these are there, what is exempt? Income in the nature of dividend, interest, LTCG. Income in the nature of dividend, interest, LTCG arising from an investment made in India, whether it can be, obviously interest means debt, Dividends means share capital, LTCG can be on both, or unit would be exempted provided the investment is after 1st April 2020 and the investment is held for 3 years. So it is a long term. Eligible investment is business trust, REIT, infrastructure development, InVIT, infrastructure development, company or enterprise or any other activity involved in infrastructure facility, category 1 and 2 of alternative investment fund. Category 1 and 2 of alternative investment fund. Okay, these will be withdrawal of exemption where conditions mentioned therein are not satisfied. That is, within 3 years you are withdrawing or any private party getting the benefit. Then in the year in which it is violated, the income already exempt will become taxable. Okay, this is one of the new amendment. I have made a detailed discussion in the amendment lectures, but this is more than sufficient. Okay, there can be a smaller question on this, and also like petroleum. Now we have, I mean, for like crude, we also brought in for petroleum income from Indian Strategic Petroleum Reserve Limited, being a wholly owned subsidiary of Oil Ministry Development Board of ONG, Petroleum and Natural Gas, as a result of arrangement of replenishment of crude oil stored in its facility. Okay, same way, RAP. But remember the Abu Dhabi fund and the sovereign funds. This might be a question 1023 FE. So in our discussion, we promised, we started with saying, okay, in the unit 1 we saw residential status to an extent we know, scope of total income we know, exemptions are over. The other areas to now focus upon is special rates and presumptive taxation. When we are doing the penalty yesterday, penalty, and when I am now, later we are going to do penalty in our direct taxation and in this special rates, I thoroughly and purely say that this is more to do with memory power. This is more to do with your memory power. All other things I can make you understand, so that even if you don't remember, from your understanding, in your own words, you can write the answer. Conceptually, you will be clear. But the special rates is not on concept based, it is only on memory based. It is only on memory based. So here a poem, you can conceptually, you need not remember, okay, substantial, you need not remember conceptually, but this 115 special rates is more to do with your memory power. Before that, let us answer some of the questions and come back to take up these special provisions. I am in page number 68, 68, question number 2. I am in page number 68, question number 2. Mr. Soham, an Indian citizen, left India on 20th April 2018 for the first time to set up a software firm in Singapore. On 10th April 2020, he entered into an agreement with LK Limited, an Indian company, for the transfer of technical document and design to set up an automobile factory in India. He reached India along with his team to render the requisite services on 15th May and completed the assignment on 20th August. He left for Singapore on 21st August. He charged 50 lakhs for his services from the company. Determine the residential status and examine whether the fee charged would be chargeable to tax as per income tax law. Read through. Stay in India during the said FY, date of arrival and date of departure to be included. Okay, so what happens? He reached India, okay, to render on 15th May and left on 21st August. He reached India on 15th May. May 16 days, 16 or 17, 17. First 14 days should be excluded. 31 minus 14 makes it 17. June fully, July fully, and left on 21st August. Okay, 99 days. Repeating, his stay in India during the financial year 2021 is 99 days. How do I say? May 17 days. He came on 15th May. Okay, he came on 15th May, so 17 days, and left on 21st August. I should include till 21st August. Okay, so 17 plus June 30, July 31, 21 days in our 99 days. He does not satisfy the first basic condition, and the second basic condition has an exemption of 120 days or 182 days, as the case may be. Okay, if his total income is less than 15 lakhs, 182 days, so second basic condition not applicable. If his total income exceeds 15 lakhs, if his total income exceeds 15 lakhs, then 120 days he should have stayed in India, so the second basic condition anyhow is not getting satisfied. Okay, sorry, somebody says urgent. Ah, சொல்லுங்க. சரிம்மா சொல்லு சொல்லு. சரி, நான் வந்து கிளாஸ் முடிஞ்ச உடனே நானே பண்ணிடுறேன். Okay, hence he is a non-resident. Okay, stay in India during the financial year is 99 days. Okay, stay in India during the financial year is 99 days. Does not satisfy both the basic conditions, so he is a non-resident. But income accrues from India. Okay, he entered into an agreement with an Indian company for transfer of technical documents and design. Transfer of technical documents and designs to an Indian company will be treated uh, and the payment received for them will be treated as royalty. The payment received for them will be treated as royalty. Okay. Okay, he charged 50 lakhs for this. Okay, the royalty received from an resident assessee slash government of India slash another NR for business or profession in India is deemed to accrue or arise from India. We all know the royalty received from a resident assessee or from government of India or another non-resident, and that non-resident officer is deemed to accrue. Hence, in the instant case, the royalty is taxable in India. Okay. Later in under section 115A, I am going to tell you this is taxable at 10%. This is taxable at 10%. No expenses can be claimed. Later under 150 here, the question is more to do with our accrual basis, scope of total income. But later I am going to tell you that also. Question number 9. J, a citizen of India. If this is not there, the answer is different. That's why I am asking. Is employed in the Indian embassy at Tokyo. He received a salary and allowance at Tokyo from Government of India for the year ending 31st March 21 for the services rendered by him in Tokyo. Besides, he was allowed perquisite by the government. He is a non-resident. Examine about the taxability. Okay. Question number 9. Normally, salaries is taxable at the place where services are rendered. So, basically, he is rendering services in Tokyo. Is it taxable in Tokyo? But this is an exception. So, I want you to write the answer little elaborate in the examination so that the examiner is very sure you know the provision. However, where the salary is paid by Indian government to an Indian citizen working in an embassy or High Commissioner office, then such salary is taxable in India. One of the exception is if it is paid by the Indian government to an Indian citizen working there. Only salary is taxable, allowances and purposes are exempt under section 10 subsection 7. Okay, in the instant case, J is an Indian citizen, salary is paid by Indian government, he is working in Indian embassy, hence taxable. However, allowances and perks are exempt. Question number 10. Mr. A citizen of India, left for USA for the purpose of employment on 1/5/2020. He has not visited India thereafter. Mr. A borrows money from his friend B, who also left India for employment 1 week before Mr. A's departure, to the extent of 10 lakhs for buying shares in X Limited, an Indian company. Discuss the taxability of interest at the rate of 10% in B's hands, where the same has been received outside India. First thing you have to understand is Mr. A and Mr. B are non-residents for the financial year 2021 because A has left on 1st May, 30 days only he was here. Basic condition 1 not satisfied, B is not applicable. Okay, so he is a non-resident. So is the case of Mr. B. He left 1 week before A. So both are non-resident. Okay. Loan is not given by Mr. B to Mr. A for any business purpose. Okay. Loan is not, that's why I said that I'll answer a question and show you. Loan is not given for business purposes. Loan is for purposes of investment. Loan is not given for business purpose. One non-resident gave loan to another non-resident, not for business purposes. Not for business purposes. Loan is given outside India. One non-resident gave loan to another non-resident outside India. It is not for business purposes. Hence, the interest received by a non-resident from another non-resident is not taxable. It's not for business. It is purely outside India. Just because both of them have an Indian origin or persons of Indian origin, it doesn't mean it is taxable. Question number 11. Divita paid a sum of $5,000 to Mr. Kulashekara, a management consultant practicing in Colombo, specializing in project finance. The payment was made in Colombo. Mr. Kulashekara is a non-resident. The consultancy is related to a project in India with a possible Ceylonese collaboration. Is the payment chargeable to tax? Yes. Yes, it is chargeable to tax. A non-resident is chargeable to tax. Okay, institute answer will be the A non-resident is chargeable to tax in respect of income received outside India only if it income accrues or deemed to be accrues in India. The income deemed to accrue or arise in India under Section 9 comprises income by way of technical services, which includes any consideration for rendering any management, technical, or consultancy service. Therefore, payment to a management consultancy in relation to project finance is fees for technical services. Clarifies section 9(2) clarifies that income by way of fees for technical services for services utilized in India would be deemed to accrue or rise in India in case of a non-resident and will be included in his total income, whether or not services are rendered in India or whether or not the non-resident has a residence or place in India. In the instant case, since the services were utilized in India, the payment received by the recipient in Colombo is chargeable to tax in India as it is deemed to accrue or arise in India. I know in exam we are not writing such an elaborate answer, but you understand the way in which the answer is written. XY Private Limited, a company having registered office in Singapore, for the first time had carried out purchase of goods in India on 4 occasions. Immediately after purchase, the company exported the same to China. The total value of export is 100 lakhs, on which it earned 20 lakhs before expenses of 12 lakhs, which were directly paid. The company seeks your advice regarding its taxability. Not at all taxable. Okay. In case of business or profession, income is deemed to accrue or arise in India only if there is a business connection. Only if there is a business connection. Business connection does not include mere purchase and export of goods. In the given case, the Singapore entity has purchased and immediately exported the same. Even if there is a time gap, it's okay. Hence, business connection is does not arise. The transaction nothing but the profit is not taxable. If repaid in Indian rupees, yes, it will be from an Indian bank account, so it will become taxable, my dear friend. Our friend's question is in the 10th question, if Mr. B has paid the loan in Indian rupees, is it taxable? Yes. Question number 12A. State whether business connection is established as envisaged in Section 9 of the Income Tax Act in undermentioned circumstances. Jupiter Private Limited, London, a non-resident company, has set up a license office in Calcutta with the permission of RBI. Indian customers are briefed of the product of JPL, by the license officer. Interact directly with the JPL for placing and processing of order. No business connection. What is business connection? Habitually secures order, stores, receives, stores and delivers, concludes contract, mere display of product, ROCO. They display the product. If you want to place the order, go to the website and place the order. Directly from US, you will get the product. Here I am only displaying, sir, this is the product, this has these features. I am not securing orders. I am not concluding contracts. I am not storing or delivering. Customers interact directly with the JPL for placing and processing of their orders. So here what I do is mere display. Business connection will be established if the agent habitually concludes contract, receives, stores and delivers goods, okay, secures orders. In the given case, the liaison office just display the product and make the customers aware of the product. Make the customers aware of the product. I just display and make the customer aware of the product. Orders are placed by the customer directly with the principal company. Hence, business connection does not exist. The question itself is the business connection existing? Test of business connection not question. Madan and Co. is acting on behalf of Nelson Incorporation Sydney, a non-resident company. Madan and Co. can accept the order, negotiate the price, and coordinate with Nelson Incorporation for delivery of the product to Indian customer. Business connection established. examine with reason whether the following transaction attract income tax in India in the hands of the recipient. A non-resident German company which do not have a PA in India entered into an agreement for execution of electric work in India. That itself I stop. Separate payments were made towards drawings and designs which are described as engineering fee. The assessee contend that such business profit should be taxable in India as there is no business connection within the meaning of section habitual security. In case of royalty, fees for technical services, if the services are rendered in India, if the destination of service is in India, then it is taxable in India. Okay, not necessarily it should be a habitual or a repeated order. In case of royalty, fees for technical services and all, if the destination of service is in India, okay, what are all the conditions we saw? Payer is a resident, payer is government of India, or payer is another non-resident, but for business or profession in India. That itself is a criteria for considering it as income taxable in India. So it will be taxable in India. Okay, with your permission, I will take the answer so that we are not wasting time in this. Fees for technical services, in this case, the separate payment made towards drawing and design are in the nature of fees for, and therefore it is taxable in India since the services are utilized for electric work in India. If you look at the case law, that means it is in that year the question appeared. You understand the base law, that is enough. Okay, where income is deemed to accrue or rise in India, such income will be included in the total income, regardless of where it has been the residence or the place or business connection. Business connection does not matter here. Services are rendered in India. Okay. A firm of solicitors in Mumbai engaged a barrister in UK for arguing a case before the Supreme Court of India. Services are rendered in India. Okay, the person who is paying is going to be Indian. The person receiving is going to be rendering his services in India, and it is taxable in India. Okay, all income accruing or other, whether directly or indirectly from any business connection is there. In this case, there is a professional connection between the firm of solicitors in Mumbai and the advocate in UK. The expression business includes not only a profession. Therefore, the existence of professional connection is also sufficient. So it is taxable in India. Amount paid by Government of India, taxable. Sai Engineering, a non-resident foreign company, entered into a collaboration with an Indian company, and in receipt of interest at 8% on debentures of 20 lakhs issued by the Indian company in consideration for providing technical know-how. Good question. Two incomes are taxable. Two incomes are taxable. What are all they? A non-resident company entered into a collaboration with an Indian company is in receipt of debentures worth 20 lakhs. Why? For providing technical know-how utilized in India. For providing technical know-how utilized in India, that 20 lakhs is also taxable, and the interest on 20 lakhs is also taxable. Are you following? This 20 lakhs is taxable as fees for technical services. Interest is taxable because it is paid by a resident. Two things are taxable. Okay. Only that part I am writing. Question number 14. Part B, nothing but soil engineering. Okay. Soil engineering, a non-resident foreign company entered into, okay. Two incomes are taxable for the financial year 2021. Debentures allotted as consideration for providing technical surveys. This is also taxable to the extent of 20 lakhs. This is also taxable to the extent of 20 lakhs. Okay, why? Services are rendered in India and the payer is also a resident Indian. So it is taxable in India. Interest on such debentures. Interest on such debentures. Okay, with an Indian company on receipt of 8% debentures of rupee issued by Indian company in consideration. Okay, let us take 25th. Okay, or let us not look at the amount. Interest on such debentures. Interest is paid by the Indian company. In other words, resident. Hence, this interest is also taxable for the NR. So, hence, this interest is also taxable for the NR. How many ever months, whatever is the period of time, this will also be taxable. So, this one statement, we understood two different incomes which are taxable. Question number 15. Part 2. Aged 45 is a resident of India during the financial year 2021. Interest of 3,10,000 was credited to his NRE account with UBI. Rupees 70,000 being interest on fixed deposit with UBI was credited to his savings bank account during this period. He also received rupees 13,000 as interest on savings account. Is party required to file his return of income? What will be your answer if he owns a shop in Delhi area of 250 for which received gross rent of 21,000, property taxes being borne by the tenant? Read through. From NRE account, 3,10,000 less exempt. This entire 3,10,000 is exempt, so not taxable. Not taxable. From FD, it is taxable 70,000. From SB, savings account, it is taxable gross total income. Though later we will study, according to section 139, if the GTI of individual does not exceed the basic exemption limit, Henceforth, I'll write it as basic exemption limit, period. If the gross total income is not, then such individual is not liable to file his return. Part is not liable to file. Part B of the question. Income from house property. Income from house property. What is that? 21,000 per month. Okay. Rent received 21,000 into 12. Standard deduction at 30%. So I'm getting from house property 1,76,400. In taxable interest, 83,000. Gross total income 2,59,400. Sorry, according to section 139, where total income before claiming chapter 6A deductions, that's why I wrote gross total income, exceeds basic exemption limit, then such individual needs to file returns. In the given case, it has exceeded, hence part is liable to file returns. Question number 16. Piyush returned to India on 12th June 2020 for permanently residing in India after a stay of 20 years in UK. He provides the source of his various income and seeks opinion on it. During the financial year 2021, Piyush has stayed in India for more than 182 days because he came back on 12th June itself. Hence, he is a resident but not ordinary resident, as he has been outside India for past 20 years. So he would not, additional conditions would not be satisfied. So he would be a RNOR. He would be a RNOR because 20 years he was outside India. So additional conditions of 9 out of at least 2 years he should be a resident in India. Not 20 years he was outside India. 730 days or more he was not at all in India. Okay, right. So on that taxability, income from letting out of flat in India, London, which was deposited in bank there. The flat was given on rent after his return. Okay, rent from property outside India received there. Okay, rent from property outside India received there, not taxable in India, where income arises or accrues outside India and received outside India, it is taxable only for ROR. Okay, not taxable for RNOR and NR, not taxable for RNOR and NR. In this case, Pius is a RNOR, so it is not taxable for him. Dividend on shares of 3 German companies which were being collected in a bank account in London. Not taxable, as he is a RNOR, it is not taxable for him. He has 2 sons, one of whom is 19 years old and another is 12 years. Both reside outside India. Both sons has an income of 75,000 in UK and 40,000 in India. Income of minor child. The second son is a minor child. Hence, the income of minor child will be clubbed with income of Piyush, assuming his income to be higher than spouse. Income of minor child will be clubbed in, hence the income of will be clubbed with the income of Piyush. Only Indian income will be clubbed. However, exemption of rupees 1,500 will be provided. Okay, so we all know that 40,000 will only be clubbed. On that also 1,500 exemption will be there, 38,500. Income of the elder son cannot be clubbed because he is not a minor. It is taxable in his individual hands, depends upon his other incomes and his residential status, everything. So only the minor son's income will be clubbed in the hands of Piyush. During the preceding accounting year, when he was a non-resident, he sold 1,000 shares which were acquired by him in British pound sterling, and the sale proceeds were repatriated. The profit in terms of British pound sterling on sale of these 1,000 shares is 37,500 in Indian currency. Okay, well, okay, no problem. Okay, consideration is also okay. Bringing money into India, repatriation. Bringing money from outside India to India is not taxable even. It's not a only income earning event is a taxable event. Bringing money from outside India to India is never a taxable event. Is never a taxable event. Question number 17. Compute the total income in the hands of an individual who is not a senior citizen, being a ROR, RNOR, and NR. Okay, a quick look at it, so that we are not wasting time. Please remember. Interest on UK development bonds, 50% received in India. 10,000, 5,000, 5,000. For a ROR, global income, wherever he earns, however he earns, it becomes taxable. For a ROR, global income is taxable. For a RNOR and NR, whatever is received in India is only taxable. Whatever is received in India is only taxable. So 10,000, 5,000, 5,000. 10,000, 5,000, 5,000. Okay. Income from business in Chennai. That's all. You should not read anything else. 20, 20, 20. Income from business in Chennai. There you can stop. If it is an Indian income, it is taxable. 20, 20, 20. STCG on sale of shares of an Indian company. I'm not bothered where it is received. 20, 20, 20. STCG capital gains is deemed to accrue or arise in India if the immovable property is located in India, movable property is registered in India. It is the shares of an Indian company. 20, 20, 20. Dividend from a British company received in London, 5,000 dash dash. Income from a dividend from a British company received in London, 5,000 dash dash. LTCG on sale of asset in Germany, 50% received in India, 40, 20, 20. 40,000, 20, 20. Okay? 40, 20, 20. You can just check the answer also, I don't mind. Okay? Or you can understand it, that's the substratum. Income earned from business in Germany, which is controlled from India. Taxable for ROR, RNOR. We have been seeing even in the poem, new residential status, I told you. Out of the 4 incomes, 3 incomes are taxable for RNOR in India. Received, accrued, income from business or profession outside India, managed from India. So 70, 70 and 40 for 40,000 received in India. 70, 70, 40. 70, 70, 40. Profit from a business in Delhi. You should stop there. Don't read where it is managed, etc. 15, 15, 15. 15, 15, 15. Income from house property in London received there, deposited in an Indian bank in London, 50 dash dash, 50,000 dash dash. Interest of debentures in an Indian company received in London, Indian company, I'll stop there. 12, 12, 12. 12, 12, 12. Fees for technical services rendered in India, 888. Fees for technical services rendered in India, 888. Profit from a business in Bombay, 26, 26, 26. I need not read further. Pension for services rendered in India. 444. Income from property located in Pakistan received there 16 dash dash. For a ROR, global income is taxable. For a ROR, global income is taxable. Past foreign untaxed income brought into India, not taxable. Bringing it into India is a repatriation, not taxable. Income from agricultural land outside India received there 18 dash dash. 18,000 dash dash. Agricultural income from outside India is taxable. Income from profession in Kenya, which was managed in India, received there but spent 5,000, 5,000 dash. 5,000, 5,000 dash. Gift on the occasion of wedding, not taxable. Dash, dash, dash. Not taxable. Interest on savings bank account, 12,000, 12,000, 12,000. Income from business in Russia, controlled from Russia, 20,000 dash dash. Dividend from an Indian company, 5,000, 5,000, 5,000. Agricultural income from India, exempt under 10.1. Even for a non-resident, it is exempt. Dash, dash, dash. Okay. Okay. Yeah, I have 2 questions to answer. Even though past incomes are just brought into India, since it is untaxed, won't it be taxed now? No, it will. I'm not saying it will not be taxed. I'm just saying it will not be forming part of current year income, whatever our working. There are separate provisions. Who has not taxed, what type of income, like that it is there. So when you are asked to compute the scope of total income, don't include it, is my answer to you, my dear friend. And tax paring, yeah, please wait, Abhi, I will come to the tax paring provisions later. Okay, thank you. Okay, let us go to section 115, special provisions that are applicable for non-residents. Special provisions, okay, as I told you, this has more to do with your memory now. It is about remembering the rates of taxation. One thing I want you to basically remember is, okay, that is a non-resident, okay, non-resident can compute capital gains in foreign currency for investment made in such foreign currency. Okay, for the investment made in foreign currency. So obviously it will be for shares, because non-residents are not allowed to buy immovable properties. So shares, securities, bonds, etc. On these only you can have it. Okay, full value of consideration. Okay, in capital gains, full value of consideration, cost of transfer, and COA, cost of acquisition, will be converted into foreign currency by applying the average of TT buying and selling rate on that date. Okay, whichever date it is, on that telegraphic transfer, buying rate, selling rate. A plus B divided by 2 will give you the average. So convert it into foreign currency. Benefit of indexation is not available. Okay, you cannot claim. I'm giving you one other benefit, converting it into foreign currency. So benefit of indexation is not available. Benefit of indexation is not available. The computed capital gains will be reconverted into Indian currency by applying the buying rate. Whatever capital gains we have computed, it needs to be reconverted into Indian currency by applying TT buying rate. So, 48 subsection 1, capital gains chapter, section 48 subsection 1 has this provision where the capital gains can be converted into foreign currency, and then reconverted into Indian currency. For administrative convenience, TDS are mapped with 115 rates. Okay, so whatever is the rate we are going to study, 194, 195 will have the same rate. The said non-resident need not file his return if this is the only income and tax has been deducted at source. You cannot claim any provisions, any benefits, any deduction. Okay, set off can be claimed. Let us start slowly. This is the major section. This is the major section. If you ask me, remember this and FII, financial institution, foreign financial institution, so institutional investor, FII. Taxation of interest, royalty and FTS, fees for technical services. Dividend is taxable at 20%. Till last year it was not there, now it is taxable. Interest, provided the investment is in foreign currency, 20%. Not all interest, I will come to. Dividend from mutual fund. Mutual fund also dividends, so same rate. Royalty 10%. So dividend, interest, provided the investment is in foreign currency, income from mutual fund, all these things 20%. Royalty and fees for technical services 10%. Now coming to some special types of interest income. Why? Because as a country we need investment in infrastructure sector. As a country we need investment in infrastructure sector. And I want to give a better benefit to the non-resident so that he invests. The foreign currency flows in and infrastructure facility goes up. So I'm giving him a concessional rate. Interest, referred to in section 194 LC. When I read that, I will refer here also. Received from an Indian company or business trust, which consists of real estate investment trust, securitization trust, all these things, on money borrowed in foreign currency under a loan agreement or long-term infrastructure bond which are approved, 5% only. 5% only. Furthermore, if it is located in IFSC, then I am only going to charge 4%. This is an amendment. This is an amendment. Normally for them also 5%. Now it is, if it is located in IFSC, then the interest is only going to be 4%. Okay. So 5% is the interest on infrastructure, 4%. LD also 5%. So how to remember this section? Check whether it is for infrastructure investment. Check whether it is for infrastructure investment either through an Indian company or through a business trust. Then 5%. If the unit is located in IFSC, 4%. All other interest, dividend, etc., 20%. Royalty, 10%. Royalty, 10%. No expenses, nothing. Offshore investment funds, OCVs. Be it any income, dividend, interest, or be it the long-term capital gain, 10%. GDR and rupee development bonds, 10%. So if you remember, other than the first one, I asked you to remember FII because there is a possibility of question in FII also. So I am asking you to remember F of FII. Dividend 20, interest 20. LTCG 10, not for 112A. Okay. 112A, it has an exemption of 1 lakh. Interest income on infrastructure, again 5%. STCG 30%. If STT is paid, 15%, 111A. Income from securities of specified funds located in IFSC, 10%. Surcharge rates are similar to individuals and HUF. Individuals and HUF, though we are going to discuss this elaborately also. Probably, if you have seen the amendment lectures, you will get it. Are taxable at a higher surcharge of 25% and 37% if the total income exceeds 2 crores and 5 crores respectively. However, dividend income 111A, 112A, dividend income, STCG on which STT is paid, LTCG on which STT is paid, the surcharge will continue to be 15%. The surcharge will continue to be 15%, not a higher range. Shall I once more repeat? Surcharge rate for individuals up to 50 lakhs bill. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, 15%. Up to this, everything normal. Where the total income excluding (111A, 112A) dividend income exceeds 2 crores, on such excess, whatever tax you are computing on that 25%, for dividend 15%, for 111A, 112A, which is STCG on which STT is paid, LTCG on which STT paid, 15%. Similarly, if that income exceeds 5 crore, 37%, but these three will continue to pay 15%. The same is applicable for foreign institutional investor, except they start the surcharge from 1 crore. Not from 50 lakhs, they start the surcharge from 1 crore. More than 2 crores, 25%. More than 5 crore, 37%. But for dividend, STCG on which STT is paid, LTCG on which STT is paid, it is continuing to be only 15%. This is a questionable area mostly. Non-resident sportsperson and entertainist. Three types of incomes are taxable at 20%. So is the rate under 194E. Three types of income: participation, advertisement, contribution of articles. Participation, advertisement, contribution of articles. Non-resident sportsperson, entertainist, and also associations. Non-resident sportsperson, entertainist, and association. NR sportsperson, entertainist, and associations. Rate of taxation is 20% on three types of income: participation in game, etc., advertisement, and contribution of articles. In all these things, this is the rate. Board of Cricket Control of Sri Lanka versus PGIT and Pilcom. Okay. Sorry to miss it out in the material, but questionable area. Okay. Judgment is 2020. When did the match take place? Judgment is to the international court. India, Pakistan, and Sri Lanka jointly organized World Cup cricket. Jointly hosted, okay, World Cup. For that, they started an organization of Pilcom, Pakistan, India, Lanka coordinations. Okay. ICC is in London, where all these bodies deposited money. Okay. Respective board deposited money with ICC. various sports association, for example, Australian Cricket Board, okay, English county cricket, okay, like this various sports association needs to be paid guarantee fee. Money was paid from the London bank account. Money was paid from London bank account. Though it is guarantee fee, though it takes the character of guarantee fee, it is like a payment to respective sports association for their participation. Though I call it as guarantee fee, for allowing their cricketers to participate, I have paid to the respective sports association. Money is paid from ICC London account. How did ICC London get the money? Because all these three boards contributed for co-hosting the World Cup. Is BCCI liable to deduct tax at source for the indirect contribution made to sports associations? The judgment was yes. The judgment was yes. ICC, so payment was made from London bank account to Australian Cricket Board. But it is deemed to have been paid. It is deemed to have been paid by the Indian Cricket Association, BCCI, to Australian Cricket Board. Section 194E and Section 115BB will be applicable and taxes liable to be deducted at source. It was held in the international court that the payment is deemed to have been made by the respective sports organization to the other sports association. Hence, the respective organizations is liable to deduct tax at source on the payment. Some of the points like at the yesterday was telling that I missed out on missed a small thing on your residential status. Whatever I am missing, apart from the theory, I will sit one day in this period and put it as an additional notes and give it to you. In my opinion, the chances of getting question in this is more because it is a recent incorporation in our study material. It is a recent, it is not even part of our selected case laws. It is a recent inclusion in our study material, so chances are more of a question, but you understand what I mean. Co-hosting of, because this is very popular, co-hosting of games. You transfer to the central fund account. On behalf of you, the central fund pays the sports association. It will be deemed as if you only paid them and not the central pool. So you should have deducted tax at source and remitted to the government. I have spoken about this at the beginning, thinking that I have not written this time. The benefit is available for investment in foreign exchange, for foreign exchange assets. Computation methodology is compute the currency of investment, take the average rate and compute and recompute. Okay. 115D to I. Investment income and LTCG on foreign exchange for non-resident Indians. This is the only chapter. This is the only sections which speaks about non-resident Indians. Otherwise, everything is about NR. It is about NR. Here only NRI. This is the only provision which speaks about non-resident Indian. Income 20%, LTCG 10%. And if they reinvest this, they will get the exemption. Where the capital gains arising from foreign exchange asset. Investment should be made in shares and debentures within 6 months from the date of transfer. It is like 54F, where the whole consideration is invested, entire capital gain is exempt. Otherwise, proportionate. Otherwise, proportionate exemption. This is the only place where starting from 115D only, you will have this. NRI. Where investment income and LTCG are the only source, then they need not file. NRI can continue to avail the benefit even after becoming a resident assessee. If NRI does not want to avail the benefit after becoming a resident, then he can opt out also. That is what is that. These are all the last part is only the provisions for NRI. Please don't understand that this computation is only for NRI. No, this computation is for all non-residents. From here only NRI specific provisions. We'll cover everything now, okay, barring the little things, okay, we'll cover everything. Question number 18. Mr. David, a citizen of India. This is important for our working. Serving in the Ministry of External Affairs in India, was transferred to Indian Embassy in Canada. He did not visit any time during the previous year. He received the following: salary computed, foreign allowance, Interest on FD from bank in India, income from agriculture in Pakistan, income from house property in Pakistan, compute is total income, gross total. For the financial year 2021, Mr. David is a non-resident. He hasn't visited India at all. 31/3/20 he left, he did not visit India. Computation of gross total income, salaries. Computer assumed that standard deduction is also provided. When they say computed, it means they have taken care of everything. If you want, you can take the alternative assumption. Foreign allowance exempt under section 10 subsection 7. House property in Pakistan not taxable as he is a non-resident. It's assumed rent is received outside India. Otherwise, it is taxable. Question number 19. A foreign company furnishes the following data. Royalty 20 lakhs, royalty 10 lakhs. Both are taxable at 10%. No expenses can be claimed. Dividend 5 lakhs. Collection charges will not be allowed. Dividend has only one deduction, that is interest on loan taken for the purpose of investment. Interest received from Indian companies on money lent in Indian currency, taxable. Taxable. Interest received from government on money lent in foreign currency, 20%. Mutual funds, 20%. Other business receipts, LTCG on sale of shares, cost of acquisition, STCG. Compute the total income of the foreign company and tax payable by it. You can do first the income and then the tax. So in order to save time, I'm doing like this. Okay. Royalty from Indian concerns, taxable at 10%, expenses cannot be claimed. So both the royalties, 20 lakhs, okay, it's taxable at 10%. Dividend taxable at 20%. Only interest on loan taken for investment can be claimed. Collection charges not allowed, but in this case, no expenses can be claimed, of course. In this case, no expenses can be claimed. Normally, for a resident assessee, only interest on loan taken can be claimed. For a non-resident, any of it is taxable because there is a concessional rate of tax. Interest received on money lent in Indian currency. Since money is not lent in foreign currency, it is not having concessional tax, but taxable at 40%. However, expenses can be claimed. Since it is taxable at a normal rate, expenses can be claimed. 7 lakh minus 80,000. Income from mutual funds, I'm sorry, foreign currency 4 lakhs. Interest received on money lent in foreign currency taxable at 20%, no expenses. So 4 lakhs units of mutual fund. No expenses again, 2 lakhs. Other business income, other business income 25 minus 10, 15. LTCG on sale of listed share. Actually, it is sale consideration. Okay, it is sale consideration on sale of listed shares, 3 lakh. Cost of acquisition 1.7. Please don't understand this as LTCG. It's my mistake. It is sale consideration 3 lakhs. Sale value minus COA of listed shares, exempt up to rupees 1 lakh and the balance taxable at 10%. So 3 lakhs minus 1,70,000, 1,30,000, okay, 1,30,000 minus 1 lakh, which is exempt, into 10%. Please understand that as sale consideration and not as LTCG. STCG 3 lakhs, taxable at 40%. Taxable at normal rates, that is 40%. Total income and total base tax. Total income, my dear friends, is 66,50,000 total base tax. So income is not exceeding 1 crore. If it has exceeded 2% surcharge, okay, it has not exceeded, it's a foreign company, and HEC at the rate of 4%. Of course, this majority of them would have been covered under TDS, but business income and all might not be. Patiently. Matthew Hayden, a foreign national and a cricketer, came to India as a member of Australian cricket team for the year end. He received 5 lakhs for participation in matches, 1 lakh for an advertisement of a product on TV, contributed articles and earned 10,000. When he stayed in India, he also won a prize of 10,000 for horse racing in Mumbai. He has no other income in India. Compute the tax liability of Hayden. Participation of matches finance. Advertisement. Winnings is alone taxable at 30%. I want to make this class clear that these people cannot claim basic exemption limit. When the tax rates are special, no BEL also. Shall I go one more step ahead and tell you that suppose if we don't have any other income but only winnings, as an Indian, as a resident Indian also, if we don't have any other income and only winnings is there, and the winnings is just 1 lakh, we are supposed to pay that 3,000 as tax, 30,000 as tax. Winnings does not enjoy basic. Anything falling under 115 will not enjoy basic exemption limit. So these people cannot enjoy the benefit of basic exemption limit. What is the tax liability? Are the income specified subject to TDS? Yes. This is under 194E. This is also under 194E. This is also under 194E, whereas this is under 194BB. Even if you have written B, it's fine. Winnings lottery is B and horse race is BB. But in exam, write it as a different answer. Is he liable to file his return of income? Yes. Had he not received winnings, then he is not liable to file. Since winnings is also part of his total income, he is liable to file. If he has not got the winnings, he is not liable to file. But since he has winnings also, he is liable to file. What would be his tax liability had he been a match referee instead of cricket? According to Calcutta High Court judgment, match referee will not be treated as a sports person. Okay, so it's an advantage. It's an advantage. Total income as computed above. Total income as computed above is 6,20,000. Total income as computed above 6,20,000. Computation of tax. Winnings taxable at 30%. How much is the winnings? 10,000. This is taxable at 30%. Balance income taxable at slab rates. So remaining 6,10,000 taxable at slab rates. 6,10,000 minus 5 lakhs into 20% plus 12,500 up to 250 nil, 250 to 5 lakh, 5%, 12,500, more than 5 lakh up to 10 lakhs, 20%. In this case, 1,10,000 into 20% plus 12,500. HEC at 4%. Question number 21. David Villa, a resident of Malaysia, had acquired 1,000 bonds of Malaysian Reals 1 lakh and 800 GDRs 8,42,000 of an Indian public sector company sold by Government of India during that year. The relevant exchange rate at that time 11.727. During the previous year, he had received interest income of 10 lakhs and dividend of 9,56,000, incurred interest expenses of 3 lakhs. He sold all the GDRs and bonds for the relevant rate when it is 16.833. He has also had other income 120, taken a life insurance policy, paid a life insurance policy premium of 145. Compute tax payable by David Villa. This is a good question. Read through. Question number 21. Let me write the base law. Non-residents have the benefit of computing capital gains in the currency of investment. Particulars. First no working note I am doing is working note for computing capital gains. GDR bonds. Full value of consideration in MYR. Okay, full value of consideration in MYR. Okay, here it will be 244785 divided by, here they have not given you buying rate, selling rate, so I should 244785 divided by 16.833. 244785 divided by 16.833. 1,45,000, 1 crore 59,40,851, 1 crore 59,40,851 divided by 16.833. 1,45,947 less COA, no benefit of indexation. COA, they have given it in MYR itself. Okay, 1,08,000. Sorry, 8,42,000. I am reconverting the LTCG into INR. Computation of total income and tax. Particulars, income, tax. Before going into this, let me go to the theory to make you understand the rates. In the case of GDRs and bonds, be it income, that is interest income, dividend income, or be it LTCG, it is taxable at 10%. Not only rupee denominated, it's bonds. Okay. In the case of GDRs, bonds, Section 115 AC is applicable. Okay. Section 115 AC is applicable. Rate is 10% for everything. Okay. Now, the question says, during the year received interest of 10 lakhs. Taxable at 10%. No expenses are allowed. 10 lakhs. Taxable at 10%. Okay. Dividend 9,56,000. Taxable at 10%. 9,56,000. business income of 1,20,000. Wait and understand. Business income from India on which assessee can claim 80C LIC, okay, life insurance premium, on which I can claim life insurance premium. For the others, I cannot do. For the others, I cannot do. For this, I can do. So, whatever I have earned, I have invested. I have invested more, but that more cannot be claimed. 1,20,000 minus 1,20,000. You cannot claim 1,45,000 because against the other things you cannot claim. Against business income, you can claim, not a problem. LTCG taxable at 10%. LTCG taxable at 10%. So, if you want to claim 80C against these incomes, nothing else can be claimed. Nothing else can be claimed. These are directly taxable. I told you, not even basic exemption limit you can claim. Not even basic exemption limit. Whereas for that business income, you can claim basic exemption limit, you can claim other things. Question number, question number 22. Mr. X, a non-resident Indian, acquired 10,000 shares in A Limited for 1 lakh by utilizing foreign currency on 15/7/20 and 11/9/20. Mr. X sold such shares for 2,25,000 and utilized the proceeds in acquisition of 5,000 shares of B Limited after paying expenditure on transfer 25,000. Compute the capital gain during the previous year. Read through. For a non-resident Indian, provisions of 115D to 115I will be additionally applicable. Apart from the normal thing which a non-resident will enjoy, a NRI will enjoy a small exemption also. Computation of taxable capital gains. Mr. X, a non-resident, acquired 10,000 shares for 1 lakh. Sold these shares for 225 after paying an expenditure of 25,000. after paying an expenditure of 25,000. Okay, so original sale consideration should be 250. Original sale consideration should be 250. Full value full value of consideration converted into foreign currency by applying average of TT buying and selling rate on date of sale. So how will I do? 2,50,000. Remember, it is after paying 2,50,000 divided by 4. Okay, 11,9. Yeah, okay. 46 and 48 divided by 2. 46 plus 48 by 2. So 2,50,000 divided by 47 divided by 47 less cost of transfer, again 25,000 divided by 47, 25,000 divided by 47, net consideration, less ICOA converted into, oh sorry, COA only, COA converted into FE by applying average of TT buying and selling rate on date of purchase. No indexation. So on the date of purchase, 45 and 46. So 45.5, I have bought it for 1 lakh. Gross LTCG in dollars. Gross LTCG in dollars reconverted into INR by applying only the TT buying rate. Okay, by applying only the TT buying rate for the 2589 into 46. 2589 into 46. Exemption under section 115F. Within 6 months, if the capital gain is invested, if the net consideration is invested, then capital gain will be exempt. Okay, in the case lab, and utilize the proceeds for acquisition of 5,000 shares in B Limited. Utilize the proceeds. So, since the entire net consideration is reinvested, whole of the CG is exempt, otherwise proportionate. In this case, entirely. So, taxable capital gain will be nil. Uh, you are right, Abhiprita. Abhiprita's question is it not short-term capital gain? She is right, but the original question is not, I think it is not 15/7/2020, it is different date actually. Uh, in the examination, this question came. At that time, it was a long-term capital asset, but I completely agree with her computation, with her, okay. So, have this answer, but she's right. I did not notice the date because I had the confidence that I know in the examination it was. 7 and sold on 11/9. Hence, it will be a short-term capital asset where none of the above provisions will apply. I'll also check once, okay. Full value of consideration will be 2,50,000 less cost of transfer 25,000, net consideration 250 minus 25, 225, less cost of acquisition 1 lakh, gross STCG exemption cannot be claimed as it is STCG. Thank you for pointing out. I went on the confidence that I know how it came in examination, but when I typed, I think I made that dates change. Sorry. Take this answer also, but I will confirm you the question once. Really very good point, very good point. Red Limited, a non-resident foreign company, had entered into a collaboration agreement approved by the central government with Blue Limited, an Indian company, and is in receipt of following payments during the year ended 31st March 20. Interest on 8% debentures of 40 lakhs issued by Blue Limited in consideration of providing know-how. So, in this line, there are two incomes. 40 lakhs is for the technical know-how. Interest 8% of 40 lakhs for 9 months, July 1st, for 9 months. Two incomes, 40 lakhs is the normal thing and interest is also. Service charges 2.5% on the value of plant and machinery leased out to Blue Limited on or before 31st March. Excellent. Apart from the above, Red Limited received a long-term capital gain amounting to rupees 1.90 on sale of debentures of Green Limited, an Indian company which they subscribed in US dollars. Compute the total income and determine the tax liability of Red Limited. Read through. First, I will do the income, okay? Fees for technical services allotted as debentures by Blue Limited. Fees for technical services allotted by as debentures is 40 lakhs. Interest at the rate of 8% on such debentures, 8% on, okay, for a period of 9 months. For a period of 9 months, 40 lakhs into 8% into 9 by 12. Service charges for leasing out of machine, it is 500 lakhs into 2.5%. LPCG on sale of debentures of Green Limited, 1 crore 90 lakhs. Gross total income slash total income, two crore 44 lakh 90,000. 2 crore 44 lakh 90,000. Okay, 1 lakh 90,000. Sorry, 1 lakh 90,000. 1 lakh 90,000. Okay, so please understand, this is royalty or fees for technical services. This is also royalty and fees for technical services. In the tomorrow's class, I will give you a summation of royalty. These two are royalties which are taxable at 10%. Which are taxable at 10%. Fees for technical services and this one. This LTCG on sale of debentures which is invested in a foreign, okay, there is no special rate available, so section 112 will be applicable, 20%. 112 will be applicable. Now the question is this 8% debentures taxable at 20% or 40%? Why? If the investment is made in foreign currency only, you will get the special rate of 20%. It's a foreign company. Here, investment is not made in foreign currency. I have to pay you a consideration. I paid it to you in the form of debentures. You have not invested it in foreign currency. So that alone is taxable at 40%. Okay. Fees for technical service and service charges are taxable at 10%. So this 40 lakhs plus this service charges of 12 lakh 50,000 is taxable at 10%. LTCG is taxable at 20%, okay, under section 112. LTCG is taxable at 20% under section 112, interest. Since it is not invested in foreign currency, such interest will not enjoy concessional facility, taxable at 40%. Interest alone, this 2,40,000 is taxable at 40%. Total base tax and HEC at the rate of 4%. As it and closing the class here today.